Good afternoon, everyone. Welcome to Invest 2030, the second webinar of the series. This particular session is dedicated to climate action and SDG number 13. In collaboration with Phoenix Capital in the Netherlands, Alpha Mundi has screened and selected 3 outstanding products that will be featured over the next 45 minutes. And the idea of Invest 2030 is to showcase innovation for SDG financing and address the supply and demand gap, or the gap perception, that a lot of institutional investors have, in particular in the Swiss market. So this is designed for institutional investors primarily. It is a free and educational webinar series. And of course, I need to mention the caveat that we have not run full due diligence on any of the products. They are coming from well-reputed managers, and the products have been screened for their impact and investment strategy by a committee of voluntary experts. But we encourage you to run your own due diligence before making any investment decisions, or more importantly, draw inspiration from these products to help you either create a more elaborate product shelf for SDG financing, or stronger or more significant allocations of your capital to that particular theme. My thanks as well to Building Bridges community. This is the Sustainable Finance Week of Switzerland that will take place on the 29th of November in Geneva. And they've been very helpful in promoting this series across multiple stakeholder segments in Switzerland and beyond. So without further ado, we'll get started with the first presentation, which is the presentation of Joe Maris from Trium. Joe, the floor is yours.
Hi, thanks so much for having me. When we started our strategy about 2 years ago, we believed there would be investors who cared about the environment, but didn't necessarily want to go long equity markets. So we wanted to create a market neutral, environmentally focused fund, as frankly, we have to do something about the environment, even if the stock market goes down, and decarbonization is going to take decades with multiple bull and bear markets. The other thing we wanted to do from the beginning is we said we really want to try to focus on the hard to abate industrial sectors, which we thought just weren't getting enough attention, considering it's about 1/4 of global emissions. We decided that's where we wanted to focus on. What we're trying to do in this fund is find companies which are now regarded as cyclical or X growth, generally with lower valuations, limited ESG sponsorship, and low ESG scores, but that we think can transform themselves in the future into high growth, lower emission ESG winners of the future. You know, we focus exclusively on the high emitting sectors. So roughly 30% of the European equity market is generating 90% of its emissions. And our view is if you want to fix a problem, you got to focus directly on the problem. So we focus not just on energy and utilities, but also on mining, transportation, chemicals, industrials, and agriculture. We're trying to find those companies that have the potential to significantly improve their environmental footprint relative to both the peers and the broader European market. And what's interesting in this process is, you know, pretty much anything involved in wind, solar, hydrogen batteries trades at pretty high double-digit EBITDA multiples. But if we can find cyclical companies trading at much lower multiples, but that can actually reduce emissions very effectively per dollar invested, we think that's an opportunity. Or for companies that are able to redeploy capital from X growth cyclical businesses into faster growth businesses with lower emissions, we think that's going to help both the companies industrially and also help the rating. Now, when we find these companies, we try to engage them directly at the CEO level. And we go to them with very specific suggestions for capital investments, operational improvements, or regulatory policy changes. Every company has a unique suggestion. We're not sending everyone the same questionnaire. This is a very research intensive process. We have a team of 3 analysts working on this, and we only are focusing on about 20 companies. We've been doing this for about 18 months, and we've already been invited to speak at board of directors meetings, had 5 meetings with chairmen of the board, and 12 direct meetings with environmental issues with CEOs. And part of the reason for this is I'm not the typical ESG manager. My first job was in the oil and gas M&A group for Morgan Stanley in New York and Houston. Then I moved to London in 1999 and worked in energy and shipping equity research for 8 years. Then I worked at GLG and More Capital as a natural resources analyst. And then I was a portfolio manager running an equity market neutral book at Societe Generale. I'm not an apologist for these industries. Most of these companies are really going to struggle in the energy transition, but we're not shareholders in most companies, and we certainly don't engage with most companies. We only see companies where we actually think we can have an impact. So I don't spend any time talking to BP or Rio Tinto or other large caps. We generally focus on companies between 1 to 15 billion as we think it's much easier for those companies to change, and we think there's more opportunities. It's very hard for large companies in these sectors to pivot because, frankly, the greener segment is a subsegment of the total industry. So green steel is a fraction of the steel industry. Biochemicals is a fraction of the chemicals industry. Sustainable textiles is a fraction of the textiles industry. And most of the successful pivots have actually been in the mid-cap area. You know, Nest Oil was a mid-cap before it changed. Ørsted was a small energy company. Our process is forward-looking. So traditional ESG analysis, we think, looks a lot at historical data. But we're trying to focus on forward metrics and companies' improvement potential. As I say, we're not trying to have a cleanest portfolio, but we are trying to have the most impact in terms of improving things. We recognize that doing what we're doing, we have a higher burden of proof and disclosure than most ESG funds. And so we've put together a pretty detailed engagement report, which we share with all of our investors. It details all of our interactions with companies and goes through our individual recommendations for each company. We're looking for companies that are going from high emitting to Paris aligned, and we sort this based on how much that costs in terms of marginal abatement cost of capital and how that will change their competitive cost position and future growth going forward. Sorry, I didn't, let's go to the next slide. I'm not sure which, I think we go to well, we'll probably go to one more slide. In terms of how we set the portfolio structure up, I talked a lot about the long book. We also have a short side. Here we're trying to generate alpha and also have impact, and the methodology here is different. We're looking for companies with we think have unrealistic or exaggerated environmental plans, or companies with unrecognized ESG issues, or a combination of deteriorating ESG and deteriorating financials. We can come on to this more in the Q&A, but we actually think on the short side is quite impactful. I mean, there's no better way to get a CEO's attention than being short their stock, I found. We also use short sector baskets, as we don't want to be structurally long any of these subsectors, whether oils or steels or autos. So for example, if we have 3 engagements in the chemical sector, but we only have 2 shorts at that time, we'll also just short the difference in the SX4P, which is the Euro Stoxx Chemicals Index. That's roughly 80% of the portfolio. We also try to keep back roughly 20% of the portfolio for opportunistic trades. Unfortunately, in these sectors, the high emitting sectors, there's ESG controversies all the time, and we like to respond to them when they occur. In terms of the overall portfolio, we're running about 140 to 180 gross, and we've run net market neutral since we started. And that's very important to our investors. We have 30 investors in our fund, and they like the fact that we're not net providing capital to high emitting sectors because we're doing this on a long short basis, and we're also net neutral or short carbon at all times. We recognize what we're trying to do in our fund is different than both most hedge funds and most ESG funds, but we think we're complementary and we're non-correlated to what the other ESG funds are doing, as we have a different investment universe and a different methodology. We've classified under a Section 8 under SFDR. We've also done a SDG report, which we're happy to share, talking about what our portfolio companies, both on the long and the short side, are doing from an SDG basis. Thanks very much for your time, and I look forward to the other presentations just as much as you do.
Thank you very much, Joe. That was extremely efficient and comprehensive as well. So next is Florence Birkett from BlueOrchard. Florence, please go ahead.
Perfect. Thank you very much, Tim. Good afternoon, everyone. So I am Florence Birkett, portfolio manager at BlueOrchard. If we can move on to our first slide. Perfect, thank you. So I'm delighted to present to you this afternoon our brand new climate bond fund. So when I say brand new, it is actually 1 week old today. It is currently a $75 million fund, and we intend to reach 100 million by the end of the summer. So like the name suggests, it's a fund that focuses on climate action. It is also a fund that has been launched in partnership with Schroders. So we use our portfolio management team at BlueOrchard, and we also use the distribution platform from Schroders. In terms of SFDR, this is an Article 9 fund. And in terms of performance, we target 2.5% above the US 3-month Treasury rates. So we can move on to our next slide. Perfect. So I think there are really 4 key points that make this fund a unique proposition compared to the existing green bond funds out there. The first one is that we're a fund that's denominated in US dollars, and we've got a focus on emerging markets. So when I say focus on emerging markets, our guidelines stipulate that at least 51% of the fund needs to be invested in EM. So to give you an idea, at launch, we had 70% of the fund invested in EM, and we target roughly 2/3. Now, that being said, we do keep an exposure to developed markets, and that is to ensure the daily liquidity of the fund. So those are names we like, the DM names as well, because they're highly liquid, and they're also a good tool to help us manage our interest rate exposure. So we think that by being denominated in US dollars and by having a focus on EM, we can provide you with an interesting yield, because what we've noticed is that most of the green bond funds out there are oftentimes denominated in euro and tend to focus on developed markets. The second point is that we've got our own impact team and impact process. That means we do not rely on external data providers for all of our impact assessments. So the impact team at BlueOrchard is completely independent from ours, the portfolio managers. They're here to basically give us the green light to invest in the green bonds, well, to give us the green light or not, to invest in the bonds we're interested in. And another power this team has is to remove from our investable universe a name that, that has previously been approved. I'll give you an example. If, for instance, tomorrow, one of the names we're invested in is at the heart of a corruption scandal, the impact team will remove this name from our investable universe. And what is going to happen then is that us, the portfolio managers, are going to have a discussion with the impact team. And depending on A, market conditions, and B, the liquidity of the issuer, we're going to decide on a time frame that we will have to fully liquidate our position. Moving on to our third point. So we're not just a green bond fund, we're a climate bond fund. So what do I mean by that? So yes, most of our assets are invested in green bonds. However, we don't invest in all of them, which is what most green bond funds out there tend to do. They will tend to invest in most of the green bonds issued on the market. Whereas because of our impact constraints, not all of the green bonds will be approved by our impact team. I'll give you another example. If tomorrow an airport issues a green bond, there is a very high chance that our impact team is going to reject this bond. So we do invest in green bonds, but we don't invest in all of them. And in addition to green bonds, we also invest in sustainability bonds, sustainability-linked bonds, and also in standard bonds, so bonds without a label, that are issued by what we call climate issuers. So who are those climate issuers? They are typically issuers who we deem have a positive impact on the environment and climate change. So 2 good examples of names we own in the portfolio at the moment are Georgian Railway in Georgia. So this is the leading railway operator in the country. And Lima Metro in Peru. So this is a subway company in Peru. Those are 2 public transport companies, and we believe this is a sector that has a positive impact on climate change and the environment. So as you can see, the diversity of the type of bonds we invest in is pretty broad. And finally, the last point I'd like to mention is that we're a benchmark agnostic. Why do we not track a benchmark? Simply because there is no benchmark out there that can mimic our impact process. If we take the example of the JP Morgan EM corporate benchmark, this is a fund that has 15% exposure to China, and this is a BlueOrchard policy not to invest in the country for governance reasons. It's also a benchmark that is heavily geared to Saudi Arabia, where the largest issuer is Saudi Aramco. And it's also got a high exposure to oil and mining companies, which are companies we want to avoid for obvious impact and environmental reasons. So this is the reason why we don't track a benchmark. This is something we like because it gives us a lot of flexibility in our portfolio construction approach. And it also enables us to have zero exposure to the countries and the names we do not like, which is something that is much harder to do for a portfolio manager that needs to track a benchmark. When you track a benchmark and you want to express a negative view, you can go underweight a name or a country, but it's much, much harder to fully eliminate the exposure. So to sum it up, we are a USD denominated fund that focuses on emerging markets. We have our own impact team and impact process. We're not just a green bond fund, we're a climate bond fund, and we are benchmark agnostic. I hope this was clear, and I look forward to your questions.
Thank you very much, Florence. It was certainly clear to me, but I'm sure that as with anything related to climate change, we will have questions on the approaches. Next is Ruperto Unzué from Suma Capital. Ruperto, the floor is yours. Maybe just to make sure you're not muted, Ruperto.
Yeah, now you
can
hear me. Yeah, sorry. Thank you very much, Tim. Okay, yeah, in my case, as Tim was saying, Ruperto Unzué, partner in charge of the infrastructure area at Suma Capital. Just first slide to introduce you a little bit about Suma Capital. We are an independent asset manager managing private equity funds based in Barcelona. We have a team of 20 people with two main programs, one dedicated to growth and the to especially investing in SMEs, and the other one dedicated to what we call sustainable infra, that I will get more in detail in this presentation. We're managing now around 500 million, mainly coming from institutional investors. We also have high net worth individuals, but we have both public and private institutional investors in our investor base, and mainly focused on ESG. In the growth part, we have ESG focused funds. In the infra part, we have impact funds. So we've been in the market for now more than 10 years, and we are now in the moment where we are going to launch our third fund, our third climate impact fund, which is the one that we are going to talk a little bit more in detail today. So next, please. Okay, our investment strategy in these funds, in these infra funds, is what you probably know is called the value add infrastructure. It's not core or core plus infrastructure. We invest in infrastructures related to two main areas. One of them is energy transition, and the other one is circular economy. In energy transition, we can invest in renewable generation, energy efficiency, smart mobility, and in circular economy, we mainly dedicate to what is waste to energy and waste to resource. The size, I mean, all the infrastructure funds, the main infrastructure funds cover the big infrastructure investments, usually ranging from 100 to 500 million euro tickets. What we are specialized in is the lower part of the tickets, I would say the low market in terms of this kind of infrastructure, which is not very well covered by the investing industry, and where we have tickets ranging from 5 to 50 million equity. So we reach investments that are between, I would say, 10 to 100 and 150 million in terms of the enterprise value or the infrastructure value. We do build to core projects where mainly we invest in greenfield projects that that impact is embedded in this kind of project related to what I said, both energy efficiency and circular economy. We also invest what we call in operational value creation, sometimes transforming or improving assets or legacy assets that are already operating, but that need to be adapted to the new situation of the market, usually trying to reduce their carbon footprint and trying to adapt them to this energy transition. And we also do what we call platform expansion, which is mainly to invest in one platform that can buy and build several assets and that can create value through that process. We have invested in this part of funds around 300 million for the moment. We are ending our second fund and start fundraising the third fund, which is going to be a 300 million fund, and that we are starting fundraising now. In this kind of investments, we have not just the financial or the return objective. In order to get market returns, we're talking about returns from 10 to 15% for our investors, but also to measure the impact. I will talk a little bit later about how we measure the impact. For the moment, we have invested in 21 transactions, exited in 7 transactions, and in terms of impact, we have avoided 7.3 million tons generated of CO2 avoided in emissions to the atmosphere. So yeah, next one, please. What we are trying to do with our funds is to try to tackle some strong mega trends. We know one of them is global warming. So CO2 emissions is one of the main issues in our funds, in our investments. We take a lot we pay a lot of attention to that in terms of the kind of infrastructure we invest. It is embedded in our investment criteria. Also, another mega trend is that technology is catching up. So we have a lot of new technologies coming to the market and getting really competitive. Renewables were not competitive years ago. Now we have grid parity in most of the technologies, and we also have new technologies reaching the market. Energy storage, smart grids, renewable gases, hydrogen, all these kind of improvements in technology give a lot of opportunity for investment in this kind of small-scale infrastructure. Also, in terms of what resource scarcity and related more to the circular economy part, what it is a big problem in our society, mainly in Europe, which is our main market, is how we consume resources and how we produce waste. And from there, we pay a lot of attention to that. And there are a lot of infrastructure related to use and reduce the waste we have in our market. So we pay a lot of attention to that. And always with what now is a lot of social and institutional pressure, both by the regulatory part, where we get a lot of support from new European regulation, supporting all this kind of new infrastructure with the Green Deal and with all the measures that are being put in place, and also by the social pressure that we are seeing day by day, and that is moving forward people to invest in this kind of projects. Okay, so next, please. Yeah, next slide, please. Thank you. So just to give you an idea, the kind of investments we made, we have analyzed in the last 3 years more than 200 projects. We have mobilized 300 million in 21 transactions. For example, we have invested in district heating networks that are fueled by renewable energy. We have invested in solar PV plants. We have invested in cogeneration in order to treat mainly to treat waste. We have invested in more than 60 energy efficiency projects in all kinds of fields, in industry, tertiary, in public lighting, etc. We have invested in waste treatment plants with anaerobic digestion and different technologies, and we also have invested in electrical vehicles. In most of the times, for example, with electrical vehicles, what we do is we invest in switching fleets. So we help companies to switch their fleet from fossil fuel to electrical vehicles, and we help them financing that with a kind of energy as a service approach. So next, please. And the last thing I wanted to point out is how we report impact. We've been kind of pioneers in the way we started with our first infra fund in 2012, and we started reporting together with PwC. We developed a way of reporting the impact. We wanted since the very beginning to be able to measure the impact. We thought it was important. Now it is something that is pretty obvious, but almost 10 years ago, it was not that obvious. There weren't many industry standards. So we started developing a tool to measure what our impact was with our investments, and we developed it through together with PwC. It is publicly available in our website. Just to give you a bit overview about the kind of indicators we measure emissions avoided, we measure energy saved, we measure how it improves in terms of biodiversity and life quality our investments, and we end up with a direct calculation, which is what we call the SEROI, the social and environmental return on investment, which is how we link the amount of money we invest in projects to what gives the society in terms of return. It's not the return just for the investors that is going to come by their side, and they're going to target that 10%, that 10-15%, but what we give as a return to society in euros, which is something that we presented this year to the PRI Awards in order to show one of the pioneer ways of reporting impact. So that was a little bit a snapshot about what we are doing in terms of climate impact funds, and happy to answer to any questions you may have. Thank you.
That's great. Thank you so much, Ruperto, for this presentation. So what I like so much about these three managers is that they're presenting very different and complementary approaches to investing for climate change mitigation and to mobilize capital in different asset classes for SDG financing across different regions. And you've noticed also that from the impact perspective, BlueOrchard goes for its own methodology because it has such an extensive experience, and so does Suma Capital with a SEROI impact. So I think that's also very interesting to note. Of course, having your own impact methodology sometimes is a challenge for investors, because then it's difficult for them to compare apple to apple. So we're moving now to the Q&A section of the webinar. We have about 20 minutes left. We had received a number of questions from participants, which I will share with you now, and then I'll give each of you the opportunity to answer any of the questions that I mentioned now. So the first one is, from your perspective, what industry or sector has been overlooked in the fight against climate change so far? Is there a major industry or sector that has been overlooked in the fight against climate change? The second question is, how do you assess opportunities across the risk-return spectrum? And what are the risks also in terms of achieving impact? And I think that especially for institutional investors, that's always a concern, right? We talk about target performance, but do we talk about target risk, right? And what are the main hurdles that you see in achieving the performance that you promise to your investors, as well as in achieving the impact that you promise to investors, right? So the risk and return profile here. There are more questions, but maybe we can start with these two so as not to overload you. I'll give the floor first to Joe. Joe, do you want to
Sure.
tackle the first question?
Look, I think it's a great question, and frankly, that's why we launched this fund, because we thought that the industrial sectors, and by that we mean steel, cement, chemicals, heavy transportation, and agriculture, which if you add them up is, depending on what region, is between a quarter to a third of emissions, don't get a lot of bandwidth on the part of investors. And I think one of the reasons for that is, frankly, it's complicated, it's difficult. People have been doing wind farms for 25 years and it's pretty established how to finance them. And I think some of these other things, when you're trying to go in and try to figure out how to design a next generation cement, that involves both technology risk and operational risk. And to do that is complicated and difficult. And so but our view is, if you actually want to fix the problem, you got to fix those problems. And our view is also, companies that are able to do that are going to have an incredible competitive advantage going forward, because not everyone's going to be able to do that. I mean, if you raise, as we always joke, if we got together and capital was unlimited, you can outsource a lot of these other tasks. I mean, you can get the money and you can go get someone else to do it. You can't get someone else to make you green steel right now. So we think if you can do that as a company, you're gonna have competitive advantage. The second point quickly on risk versus return. I mean, absolutely, we're looking at this from a adjusted risk perspective, and we're trying to run about 7% volatility in terms of how we look at that, and we monitor that pretty closely. And we try to be both factor and beta neutral to the market. So, I mean, we're a daily quoted UCITS fund, so it's pretty obvious in terms of where the marks are going. So we're happy to just send you the data, and you can draw your own conclusions.
That's great. Thank you so much, Joe. Florence, your views on overlooked sectors as well as the risk-return balance, both for financial performance and for impact.
Sure. So for the first question on overlooked industries, I mean, I fully agree with what Joe has said so far. And I think what's really interesting that we've noticed in the fixed income market so far, so for instance, the green bond market has been growing substantially over the past 5 years or so. And what's been really interesting to notice is that we have seen companies across all sectors making substantial efforts towards climate change and their impact from an environmental perspective. So yeah, as Joy said, I think there's really a long way to go across sectors, and yeah, that's really a trend we've seen everywhere. With regards to the second question, in terms of risk and returns, so you mentioned risk on the impact side as well. I guess it's a bit special at BlueOrchard since we've got our own impact team, and they make sure that from an impact perspective, all of our investments meet a certain threshold. And this is really what we like about our fund. We like to think of it as a fund that has kind of a double threshold. So we make sure that from an impact, or the impact team makes sure that from an impact perspective, we are in line with our ambitions, and then the portfolio management team makes sure that from a valuation perspective, the bonds we will invest in will be attractive enough for the fund.
That's great. Thank you so much, Florence. Ruperto, what about you?
Well, in our case, maybe in the infrastructure field, I would say that everybody's paying a lot of attention to power generation through renewables. Wind and solar is well, a lot of projects are there, a lot of money is getting there. But there are many other technologies in energy transition and circular economy that are not so well known, and that are also very important for energy transition. Everything related to renewable gases, the transformation, and both in the industry but also in other waste generators, from waste to renewable gases, in order to lower the carbon impact of our thermal energy. We have in Europe, we have strong networks for natural gas. We need to lower the carbon impact of those networks, and that is mainly through renewable gases. And it is something that now everybody is talking about hydrogen, and it looks like only hydrogen is the solution. But there are many different technologies like biomethane and other specific ways of reducing the carbon footprint of our thermal energy. So I would say for us that is now one of the priorities. And in terms of the risk return question, I would say, well, in the infrastructure space, there is a risk return well known by institutional investors about core infrastructure. It's pretty tight now because of the well, dynamics of the market. But our view is that there is an interesting spot in the value add infra, as we say, because you're going to have projects and infrastructure that mainly has the characteristics. It's asset based, is inflation protected. You have long-term visibility cash flows. So you have the main features of what infrastructure is, but because of the size and because of the value add you need to do in that infrastructure, you're going to get more attractive returns. We're talking, as I said, you can switch from I would say mid single digit to reach low teens or even in some strategies be close to 15% in terms of IRR for investors. So we think it's very value add infra. We think it's a very interesting balance between risk and return for the moment.
Thanks. Two more questions. The first one relates to what we've just been discussing. It's have you been observing trends towards standardization of climate metrics, and does the lack of standardization hamper your work? And this in particular because yesterday there was an interview of Mark Carney and run by Rosa St. Georgia from Pictet. Mark Carney is of course former Central Bank of England, and also now leading the charge for the UN on climate change finance. And he mentioned that climate metrics standardization was key and still an issue for many in the industry. So what's your view on that? And then there'll be another question on satisfying the criteria for mainstream investors. The question is quite detailed. It asks about proof of concept, market depth, data availability. Maybe a simpler way to tackle it is, could you mention the types of institutional investors that you have in your as clients, and perhaps already in this particular fund that you've featured, and how do they relate to the products that you offer, right? What's the match between your products and institutional investor requirements? We'll start again with Joe, if that's all right.
I mean, look, the answer is he's absolutely right. I mean, clearly there is a lack of standardization in all of these metrics. I mean, where it is most apparent to us is in the scope 3. I mean, we have companies who have of doing exactly the same thing and they score it totally differently in scope 3. And I think that's, we use the CDP methodology ourselves to try to work out our own scope 3 assessments because we're kind of sick of taking what the companies say. I think, frankly, SDGs, I mean, that's another area where every company seems to be doing it differently. There's a lack of standardization. I know that wasn't the question, but that's another area where I think you kind of have to have your own methodology at this stage, or at least, rely on something established rather than just taking what the companies say. I would say, unfortunately, one of the things in the investment industry is everyone just wants to find an answer on a Bloomberg, and people don't actually want to think or use common sense. So I hate to say that, but that's just the fact, right? So I think a lot of these things, if you actually have experience in the area, understand the segment. I mean, we have site-specific data for 10,000 specific emitting sites in Europe. You should be able to figure out what the emissions footprint is of a lot of these companies. It's not like they're doing something which is totally unique or totally differentiated. So I think if you put the time in, you can get close to the answer, frankly, even if the data is not being adequately disclosed. But it's just incumbent on the investor to actually have this, put the effort in and have the specialization to be able to do that. So I know the quant people don't like to hear that because they want to have everything that they can just put in the spreadsheet, but unfortunately we're not there yet. So it's just incumbent that everybody recognizes you actually have to do some work. To your second point on investors, I mean, as I said, we have, right now on our UCITS fund, it's about 90 million USD, and we have 30 investors in that. And we have investors of all types. We have both high net worth individuals, we have private banks, we have family offices, we have institutional investors, we have commercial banks, et cetera. We even have fund of funds who are in there. I think the one thing that is common among all of our investor group is that they're clearly focused on ESG and climate change as a driver of what they're doing. The other thing that's common is that generally we're not the only way they're trying to make an impact. So almost all of them also own ESG loan-only products. A lot of them own ESG-driven private equity products. They may also be investors in the other people in this panel, for all I know. But they basically say, our view is that if you're going to build a portfolio, you need to have a suite of ESG products. And they say, they always tell us, they say, look, there's $4.5 trillion of hedge fund assets out there, and as best we can tell, almost none of them is doing anything from an ESG perspective. So, we need someone to do that, and so we're happy that you're providing that space in our portfolio. Anyway, so I think there's, we have pretty much all types of investors in our fund.
Yeah, I have to say that so far, hedge funds remain one of the unconquered fields of ESG. And
well, that's because it's complicated and difficult, right? It's a bit hard. It's it's a bit harder, and also you can't run it at 10 times leverage, and you have to have a bit of a longer duration attitude toward these things. I mean, this problem's not going to get fixed in a quarter, right? And I think, frankly, most of this hedge fund space is very focused on very short-term arbitrage or very, very near-term catalysts, and they're not trying to actually, do something which is substantive, and that's what I think is required in this area.
Speaking of doing things in a quarter, just out of the loop here, what's your view on achieving the SDG 13 or other SDGs by 2030? Do you think that's achievable given the sort of mobilization of capital and the impact that you guys are able to deliver?
My opinion is, yes, it is achievable, but it's going to require a heck of a lot more than what's going on right now. I mean, it's achievable, but it's not at the current pace of activity.
Excellent. Thanks, Joe. Florence, what about you on these two questions?
Sure. So in terms of standardization, no, it is not something we have seen so far in fixed income markets. So I don't want to bore you and get into the nitty-gritty of the fixed income technicals, but to give you an idea, so when we invest in a sustainability-linked bond, the specificity of those bonds is that they have specific KPIs that the issuer needs to meet. If those KPIs are not met, then the coupon will step up, will increase. So it's a cost for the issuer. And here, the KPIs we're seeing are very, very different across firms and sectors. So the ones we often see are, CO2 reduction in water usage, building or construction of greener buildings. But you also have the more random, I would say, KPIs, such as reintroduction of certain species in the ecosystem. So no standardization seen as of yet, and definitely a broad range of climate metrics that we are seeing. And with regards to the second question, so our largest investor is a large bank based in Scandinavia. Other than that, we've got the usual suspects, so wealth managers, banks. So yeah, those are the main investors in our fund at present.
Thank you. And regarding my question on getting things done by 2030?
Apologies, Joe, but it was so well said. I think I'll just veto that. Yes, it could be done. And also we have to believe in our in our fund ambition, but we will have to increase the pace at which things are going.
Wonderful. Thank you, Florence. Ruperto, what about you? What's your view on metric standardization and how your products respond to institutional investor criteria?
Yeah, I would say for us, standardization would be great. We would love to have more standardized indicators because, as we have many different investors, what if you don't have standardized indicators, what you end up having is lots of different reportings for your impact. So it's a lot of extra work to be done for us. So how we see it now is that because you have like two main streams there. One of them is all the indicators related to ESG, but also you have all the indicators and all the methodologies related to impact. So you have two different trends there because as you know, it's not the same. So and there are different ways of addressing that. Now in Europe, we start to have somehow a consensus with all the taxonomy and the related, let's say, indicators that are going to be in line with taxonomy. So that is something that we start to hear a lot on the investor side. So they start asking us if we meet the taxonomy requirements and so on. It's true that we are adopting I would say the state-of-the-art methodologies that we see in the market. We are GRESB, SASB in terms of measuring the impact. But it would be great to have a very clear impact standards for the coming future in order to make our life easier and also to make it clearer for the investors in order to compare, because that's very important. So they can compare and they can say, okay, what is the impact of your fund and what is the impact of this other fund? So for us, it would be great. We are supporting the way we can all those methodologies, but there is still room for improvement. And in terms of the kind of investors we have, as I said, mainly institutions. We have public institutions like, for example, the EIB. We have the European Investment Bank. We have also private institutions, mainly pension funds, that are very well interested in impact and in investing in this kind of impact funds. Also, some insurance companies and high net worth individuals. So we have a mix of these type of investors. And yeah, and the other question, yeah, sorry, if we are going to be able to meet the requirements for 2030, I think it's in our hands. I mean, the money is there, technology is there, so it's for us. I mean, for managers, is a great opportunity, and we think we can do it. I mean, we have the fundamentals there, and it's a question of being efficient in deploying the money, in well, doing things right. So, but yes, I'm optimistic about that.
Fantastic. We have time for two last questions. Perhaps as I'm asking them, Nora, can you go back to one of the early slides on setting the stage for climate change? Because as we speak about, is it achievable? What's the level of ambition? I think these numbers are useful. Now, the first question is on public-private platforms. Do any of you know about public-private platforms that address key risks related to climate, health, and others, and that you can invest in? And the second question would be, if you had one wish to see fulfilled by year's end, what would it be? So, Joe, the last two questions. First one is public-private platforms, and the second one is your wish.
Sure. Well, look, I think the other two panelists would be better qualified to speak about public-private platforms, so I'll defer that to them. I would say, one wish I can say is Europe has been a great leader for the world, and I would hope that if a little bit of that can rub off in some of the other continents, both in terms of from a regulatory perspective and also from a carbon price that actually I still think the European carbon price is too low to really incentivize actions in the areas that we're looking in, but at least we're heading in the right direction. So I would say if we were sitting here a year from now and there was a 50 euro carbon price everywhere, I think we'd be a lot quicker to than where we are right now, because Europe, unfortunately, just in terms of numbers, is still only 13% of global emissions. So it's a big world out there.
That's great. That's well understood. Thanks, Joe. Florence, what about you?
Yeah, so on the first question, actually, on the public-private platforms, can you share some examples? I am afraid I cannot answer to this question. I'm happy to look into it and to get back to the audience later on, but no, I don't have any relevant answer to this question right now. With regards to the wish, yeah, I just hope we keep seeing lots of efforts, not just from corporates, but from governments globally with regards to climate change, raising awareness and taking concrete steps that can improve the current situation.
Thanks, Florence. Let's hope that you're heard. Ruperto.
Yeah, I'm sorry because the first question also I don't know exactly what they're referring to, so I don't know how to answer it. And in terms of the wish, I would say I've been in this sustainability market for a long time now, for more than 20 years. And the reality that we're living now, it's true that we have a lot of problems out there, but it's everybody is concerned about this. So my wish would be for this to stay. I mean, this awareness, I hope is not going to be something that now we are all very aware about this, but in 2 years, the awareness is going to move away and go somewhere else. Please, let's stay here because it's very important to move on in all the climate change related issues, and we cannot assume this to be something temporal, and we need it to be permanent, and we need to keep this awareness for long term.
Yeah, duly noted. Maybe I can add to that a couple of things. The first one is that the UNDP is coming up with SDG investment maps, where they map out a country's set of opportunities for SDG financing. And these maps will become more publicly available as of this fall. They're in the final stages of preparation for more than a dozen emerging market countries. Another public-private type of collaboration that we can imagine is what we saw a few years ago between FMO and ABN AMRO, when you have a development bank that offers its whole portfolio as co-investment opportunities to private sector institutional investors, so that we can piggyback on their due diligence and their field presence and their know-how. And that, I think, has worked quite effectively. And finally, in Switzerland, at least, we have upcoming the Swiss Impact Investing Initiative by SECO, by the Economic Ministry, and it will seek to accelerate existing platforms of PPP as well as impact products and innovations for the SDGs and for sustainable development and the transition to a sustainable economy that we're all wishing for. That really concludes our webinar for today. My thanks to wonderful speakers, really, to be so concise and comprehensive and very much appreciated. Thank you, Joe, Florence, and Ruperto for making the time to feature your funds and your work. Very inspiring. The next Invest 2030 webinar will take place in September, October, and November, so 3 more before end of year, on different SDG themes. And in the meantime, you will be able to find this presentation on our LinkedIn page, Invest 2030, as well as on the Alpha Mundi page. If you have any questions, just reach out to us or to Phoenix Capital, and we'll be happy to put you in touch with the managers or try to address further questions on this particular theme. My thanks to everyone, and have a nice end of day. Thank you.
Thank you very much.
So much.
Thank you very much.
Have a lovely day.
Thank you.
Bye.
Bye-bye.